If this is the only thing you take away from this podcast, this is it. All right. And that is that the founders cannot explain the problem that they're solving well enough. So they have this awesome solution. They have spent so much time thinking about living, breathing, whatever their solution is. They think it is the greatest thing that ever happened to mankind. However, if it is not solving a really big, sticky, hairy problem, then people are not going to change their behavior. They're not going to buy it. So if I can't really understand the problem that they're solving and why this problem is so bad, then that to me is a big red flag.
I'm Brandon Reed, and you're listening to Ready, Set, Startup, a podcast that brings you industry-tested perspectives from leaders working in all areas of the startup lifecycle, so you can learn from the wisdom that they've gained over years in their fields of expertise and apply it in your own entrepreneurial journeys. Let's get into it. In today's episode, I'm interviewing Marcia Dawood. Years ago, Marcia heard the words angel investing for the first time. Unsure of what all that entailed, she went to an event where she learned more. Fast forward to today, and she has a large portfolio of companies that she invests in as an angel, either on her own or as part of a larger network. She's given a TED Talk on the topic, and she has a podcast and brand new book that helps others understand how they can start investing in private companies themselves. She even advises the SEC as a part of a panel that helps the federal government understand how to best support and get capital flowing to small businesses. Needless to say, she's become quite an expert. And I am just thrilled to be bringing some of that expertise to you in this episode. We start by digging into Marcia's background, that first meeting where she began learning more, and all the misassumptions she had when she first got started.
Yeah, so in 2012, I was invited to an angel investing meeting, and I remember thinking, cool, what's that? Like, what exactly is angel? I had no idea. I had absolutely no clue. And I didn't know if it was like people were going to get together and buy stocks, or I have no idea. I just knew it was something about investing money.
Do you grow wings?
Exactly. Yeah. Somebody described it to me as the other day, like they thought an angel was somebody who just kind of like trickled down and then, all of a sudden dumped a whole bunch of money, and they have to be like a bazillionaire and all that kind of stuff.
Yeah.
But little did I know, and I was living in Pittsburgh, Pennsylvania at the time, that there is so much innovation happening really all over the world, like in every city and every town. And there was so much going on in my own backyard that I had no idea about. So I go to this meeting, and it's basically three entrepreneurs pitching about their business or talking about their companies and what they were building, what they were working on. And they're looking for investors. And now angel investing, simply put, is when people use their own money to invest in a private company. So in a lot of cases, we hear about the public markets, and that's when you would go on to maybe a platform and you would be able to trade, very quickly in and out, very liquid stock. Private is very different. So if you're an entrepreneur like I saw on that very first meeting, they're looking for somebody who will be in it for the long game. And because you can't just get in and get out, basically. So I was fascinated. I had no idea that this was happening right in my own backyard. And I was working in corporate America, kind of doing the same thing and thinking I was going to get somewhere. And then I started to realize, wow, there's this whole world out there I didn't even know about.
And so did you dabble in entrepreneurship yourself? Like how were you even aware of that world and how to line into that? I guess your friend was an entrepreneur who took you to that meeting?
Actually, my husband's in finance, so he got invited. And
Okay.
I said, well, what's angel investing? And he's like, I think it's like investing in private companies. But he was working for a public company, so he was kind of like, let's just go see what it's all about. Like, I'm
Right.
sure.
Let's talk a little bit more about what angel investing is in a little bit more detail. I mean, how's it? You said it's private companies. How does it differ, though? Let's even talk about from the entrepreneurs or the founders' perspective. If they think about, okay, I need money to grow, need cash infusion, I need to raise capital. I've heard I need to raise capital. Most people are aware of venture capital. How does angel investing differ from that and other types?
Yeah, so angels are usually individuals who form either a group or they work within a fund, but they write checks from their own checkbook. Venture capital is when there's a manager who raises money and then they have a fund where they pool capital and then they invest out of that fund. So that's basically the biggest difference between angels and venture capital. And for the most part, an angel will invest earlier or really when the company is just getting started, just starting to grow, over a venture capital firm. They're kind of waiting for the angels to come in and see, what's interesting, what will grow. And to your question about like, what is it that the founder should really be doing is if they're looking for capital, either from angels or from venture capital firms, they really need to have a company that is scalable, meaning that that company will be able to grow and scale. Like that whole hockey stick thing that we hear about, it just basically means that you're going to have, a little bit. It could be revenue, customers, whatever it is. And then it's just going to, grow and scale because those customers want whatever you're building so much.
You started touching on this, I think, with that, but let's dig a little bit more into what kinds of companies should look at an angel investment versus other kinds of capital. Who's right for that path?
Yeah. So most of the time it comes into 3 buckets, and that would be tech, life sciences or healthcare, and consumer products. So those are the 3 things where you start to really see that scalability. So if companies are, in those categories, there's a chance that they could be positioned for that type of investment. But nowadays, there are more ways that like the small business, the Main Street businesses can get into, can get some investment too. So we could talk about that if you want.
And can companies raise angel investing? Raise an angel round along with other, can it be in conjunction with it, raise an angel round and then go and do VC?
So yes, that has definitely happened before. For the most part, what we've heard from the Venture Capital Association, which is like basically the main trade association for the country on venture capital, is that about 90% of the companies that VC firms invest in are backed by angels first. So you'll see that it's an earlier stage. It is risky. I am not a financial advisor and I do not give financial advice. Go talk to a financial advisor for financial advice. However, that it is a risky asset class. And in a lot of cases, I know I'm a part of the Angel Capital Association, which is our professional society of angel investors in the US. And we say that you should not have more than 5 to 7% of your investable assets invested in this asset class because it is risky.
I know that a big part of coming in as an angel, well, let's even talk about from a VC perspective. Me as an entrepreneur, as a founder, all I hear, because you hear more about VC funding, I hear that, hey, one of the biggest pieces of that, yes, money's helpful, but the network is helpful. The connections are helpful. The expertise and industry knowledge is helpful, especially if you're at a firm that invests in companies just like yours in your industry. Do angels also offer that? Is that kind of part of the deal? If you get an angel kind of behind you or an angel network behind you, is that also offered? What does that look like?
In a lot of cases, you'll see the earliest angels will really, really be able to help the company grow and scale. And sometimes it can come down to just 1 or 2 that are working with the company as an advisor who can really get them to the next level.
And so when you started investing as an angel, how did you feel like your background prepared you to do that, to be able to be an asset in that way to founders who you're funding?
Well, I really didn't. I thought that you had to be rich, you had to have a finance degree. I thought like all of these kind of misconceptions. And maybe like back in the 80s or 90s, you had to be rich and you had to do all these things. And it wasn't as easy as it is today to get involved. But I've come to find that really anybody with any kind of background can be extremely helpful to a startup company. Because think about it, it's really, really hard to grow and scale a company. And they need all kinds of support, bookkeeping, human resources, like all these things. Most of the time people think, oh, well, I would have to really know something about finance, or maybe I'd have to be a lawyer in order to help them. And that's just not true.
Yeah, that's just not true. There's so many, applicable things. So we're dancing around a little bit, but let's talk directly about kind of how then, who can invest as an angel and how you do that. I know there's some creative ways to do that. Kind of dig into that.
Yeah. So on the surface, if you want to write a check to invest in a private company, you have to hit what is called by the Securities and Exchange Commission here in the US, the accredited investor definition. Now, I really don't like the name of it because it implies that you have to have some kind of certification or something like that. That whole word accredited is kind of strange, right? So what it means, though, is that you hit a certain income or wealth threshold, and that is $200,000 in income by yourself, $300,000 if you include a partner or spouse, or $1 million in net worth minus your home. So that's really what you would have to have as far as income or wealth in order to make a direct investment. However, there are ways nowadays that you can invest for as little as $50 and you do not have to meet those minimum thresholds. And that's through what's called equity crowdfunding. So people have probably heard of Indiegogo, Kickstarter, GoFundMe. Those are all ways to crowdfund in different ways. Some are rewards-based, some are donation-based. Equity crowdfunding is where the crowd, again, is getting together, they're pooling their money, and they could potentially get a piece of ownership then into the company, hence the equity piece.
So, I mean, when you say, as little as $50, you're going, these are platforms that are offering these
That's right.
options. And then you're going in and saying, oh, this interests me. And you can just take tiny, tiny pieces without being an accredited investor to do that.
That's exactly right. And what I love about that is there's several platforms out there. There's 3 in particular that have the majority market share, and that is Republic, WeFunder, and Start Engine. And what somebody could do, though, which I did not have the luxury of doing because these things did not exist back in 2012. They only happened because of the Jobs Act, which was in 2012, but they didn't actually come to fruition until 2016. And what I love about them is that you can learn without really ever having to invest a dime. I mean, yes, you can invest for much lower dollar amounts, but let's say you didn't really want to invest right away, which I always encourage people to look around first. Don't make an investment right away. But if you wanted to just learn about different companies, see how they how they would pitch, how they would
totally.
just present their company, how do they present what's going to happen in the future? All of that is disclosed on those platforms. And nothing can actually, this is the part I love, nothing can actually be disclosed off of the platform without everybody who's on the platform knowing about it. So let's say that I happen to know the founder and I went and had a conversation with the founder. That's a no-no, because if we were going to talk about the company or I were going to ask questions, that all has to be done through the platform. And there's a really great Q&A section that I encourage everybody to read, because that's where you really start to see how the company is answering questions.
That's really good advice to, just poke around at first, like see how are people pitching? How do companies even frame themselves up? I would imagine as a founder, it would even be helpful, not even as an investor lens, but as a founding lens, to go in and say, how are people talking about their companies? Like, how are they making themselves attractive to investors? So that's interesting.
That's exactly right.
And good advice. Let's talk about when you evaluate a startup. If someone's kind of pitching to you, off these platforms, you have an opportunity to invest in a company, they're pitching to you. This is a big question, but how are you evaluating these startups? What are the key elements that you're looking for? And I guess the broad question around that is like, what do founders that get funded do differently and well that founders who don't get funded don't do?
Mm-hmm. So I can sum it up into like basically one thing. Well, it's a lot of things, but there's one thing in particular that I find that most entrepreneurs do not get right. And that is, so if this is the only thing you take away from this podcast, this is it. All right. And that is that the founders cannot explain the problem that they're solving well enough. So they have this awesome solution. They have spent so much time thinking about living, breathing, whatever their solution is. It could be a tech product. It could be a consumer product. It doesn't matter. They think it is the greatest thing that ever happened to mankind. However, if it is not solving a really big, sticky, hairy problem, then people are not going to change their behavior. They are not going to buy it. So if I can't really understand the problem that they're solving and why this problem is so bad and why it's not being solved by anybody else right now, or it's not being solved in the right way, then that to me is a big red flag. Yeah, no, that's good. I talked to, on this show and just others in my network, I talked to so many founders who say, when they apply for an accelerator or they do anything else where they've kind of documented an answer to like, talk about the problem you're solving. They say they go back and they'll read that and be like, all I did was talk about my solution. Like it's such a trap you fall into. It's like, hey, talk about the problem you're solving. Like, here's how I'm solving the problem. And you just type that out or you say that. And then you hear over and over from investors on the other side saying, I want to hear about the problem, like obsess about the problem, not the solution. So that's a really good confirmation of that. There's so much I know to a startup and to a founder and a founding team that's intangible. Like you can look at the numbers, you can see the graphs, but there's a feel, there's an it factor. How do you evaluate that? Like for an investment that I'm sure has so much to do with numbers, those things are important.
to make sure you're not making risky investments. But how do you evaluate those intangibles and skill sets and giftings that that unique team or that unique founder brings to the table?
Yeah. So when a company's pitching, usually they only have 5, 7, 10 minutes to get the investor's attention. And that's really so that they can get a second meeting. And that's sometimes what I think entrepreneurs forget about. Like they just think, oh, I have to nail it in this 7 minutes or, forget it. They're never going to want to talk to me again. Actually, you just want to get the curiosity peaked enough that they're going to want to talk to you again. And that's when you start to have conversations that are much longer. You're not on a clock. You're not in some kind of crazy time limit. And that's when as the investor, we start to actually see, how does the team work together? Who is the team? Is it, in some cases with tech especially, you can have a bunch of people who really know tech and they know how to code, and then they all kind of form together and they become co-founders, but yet nobody's an executor. Right. Nobody knows how to do operations, right? Totally. Nobody knows how to sell. So now we got a problem because we've got some really amazing tech people who are building an incredible product. It's never going to go anywhere. Nobody's ever going to buy it.
And so you're saying that you need to be looking for those things to understand what sets of expertise that team has, or even that single person has, that will make the startup be successful.
That's right.
Okay. Yeah, that makes sense. What have you found the most reliable indicator to be of kind of that it factor? As you're looking and you're saying, yes, you guys, you as a team or as an individual founder, you have the skill sets needed. What is that trigger of you're like, oh, this team has it?
Well, that's always really hard because sometimes you'll think, oh, this team really has it. And then it happens. And so you never really know.
Yeah.
Right?
Yeah. Some people are just good at talking. Yeah.
Some people are very good salespeople. And sometimes that can be a red flag.
Yeah.
Right?
Yeah.
So if you have a founder who's really good at sales, then you should maybe start to worry just a little bit. But the one thing is, who is actually going to be getting the things done? So who is your operations person? That's who I always want to talk to. Like, who's going to be the one who's going to get out there, who's going to make sure the pricing's right, who's going to talk to customers, who's going to make sure the company's making money, all of those things, and really execute on what the vision of the company is.
Yep. No, that makes total sense. And in fact, as I get started my entrepreneurship journey, at least my full-time one, those are areas that very quickly I found out, like, man, I don't know this part. I need to learn this part. I know how to build a world-class digital product. It's what I did in my career before. It's what I knew how to do. I just basically extended my job at Disney doing that in my own product, built this digital product, launched it, and thought, man, I need to get really, really good at operations. I need to know how to sell. I need to know how to market, or at least bring people around me that do know those things. And I think that's got to be such a huge gap. People can be, we know all these personality types. People are visionaries or they're strategic implementers, and people with these big, big ideas write it on the napkin and come with an idea that's going to change the world, but no plan of how to execute. It's that Paul Allen and Bill Gates scenario, right? Like you need a Paul Allen to a Bill Gates. So that makes total sense. And it makes sense as an investor, you'd be looking for that Paul Allen situation. So talk about, if you can recall one, just a specific example of when a company did knock it out of the park. Like when people are like, hey, how do you do it right? And you consistently go back to that example as like, well, this company is a great example of that.
Yeah, I think a lot of it has to do with cash conservation. So if you talk to any angel investor really, or any VC person, they'll probably tell you that the majority of the companies that don't make it are because they ran out of cash. Yeah. But did they really run out of cash, or did they just not use the cash really efficiently so that they were able to build and grow the company at the time that they did? So what I always like to see is, like, when a company's fundraising, what are the milestones that they plan to hit with the money that they're currently raising? Yeah. And then if they hit those milestones, then they can go and raise more money. But I think what starts to happen is they kind of lose track of what the milestones were that they kind of promised the investors once they get the money. And then they go a little bit sideways, or they start to pivot, or something starts to happen. They're not getting as many customers as they wanted. They're not growing as fast as they thought they would. And so now they're in a bit of a pickle.
You hear this idea of, milestones, these specific things you set out. Once you start getting funding, that's one of the risks, or specifically with VCs, one of the things that people really caution against is like, hey, once you start on that train, man, it's a pressure cooker and there's things you got to hit or else you're in trouble. And so you set those things out. There's a lot of this concrete, but then you're specific as a founder, you're always told, be ready and willing to pivot, switch your focus if you need to. So there's this like, hold your vision in an ironclad fist, like this is your vision and fight for it. And like pivot really quickly, be flexible, make sure you're ready to change everything if the market's telling you need to do that. And I imagine that once people get money, it can very quickly become that like, well, we're told we need to pivot. We're told we need to be flexible. I think this and shiny object syndrome sets in. And I'm assuming that can just burn cash very quickly.
And in a lot of cases, what happens is the investors are not told what's going on. So once the fundraise is done, then the entrepreneur isn't quite as good at communicating. But man, when they want that check, they'll be right there. They'll be answering emails at 11 o'clock at night, whatever. But as soon as that money comes in, they don't. And that drives me crazy. I actually just had to hunt somebody down the other day. And it was basically because I was a female. And my husband was the one who made the original introduction. Oof. And I guess he just thought that I didn't really know what I was talking about and he didn't have to answer me. Yikes. And so I went back to the person who had introduced both of us to him. And I was like, hey, can you find out what's going on with this? Like, are they out of business? I literally hadn't heard from them in over a year.
Whoa.
Ridiculous. Whoa. Like, and I'm like, email, and then I would forget, like, I was just like so frustrating.
Yeah, and then it's on you to remember. You're like, why is this on me?
You need to remember that I'm trying to hunt you down? No, don't make me do that. That's super
frustrating.
Crazy.
Wow. Is that not baked into part of like check-ins? Is that supposed to be in the contract or agreement?
100%. And in a lot of cases, here's what happens. Especially with the little angels like us, I say little only because our checks really are smaller, but we're the ones who are helping get these companies off the ground, right? So in a lot of documents, when there is a priced round, so what we're talking about there is that there no more debt, no more like, hey, we're going to have a convertible note or whatever we're doing. Like we are actually going to raise money, we're going to price it, and everybody's getting stock, meaning that all the investors are now going to have ownership in the company. All right, well, when that happens, there are provisions in the term sheet and then in the documents that would say that a major investor has what's called information rights. And information rights means that you will get information from the company at least quarterly, and you will get all of their financial statements on a quarterly basis. So what I tend to do, and what I would highly recommend others to do, is if you are not a major investor, and by definition, major investor means you're writing a pretty big check, and in a lot of cases I wasn't, or my group wasn't, or whatever, but we would ask for a side letter, meaning that we were asking for, hey, we'll sign this paperwork and we'll become an investor in the company for this like little portion, but we also want this major investor right. So you have to basically consider us major investors, even though by definition we didn't meet that. But if you have a side letter, then that means an attorney wrote it up and you should have access to that. And what that means is you should be getting quarterly reports. But you'd be surprised like how many companies just don't even do that. Or I'll be like, okay, so the quarter, January, February, March. Okay, so right now it's April, and now you're like, okay, what am I supposed to do now? I haven't heard from them. Let's say now it's like April 20th. And you're like, okay, well, we'll give them a little bit. I know it takes a while to close the books, whatever. But now it's like May, right? And then what do you do? So it's just like, you get to a point where you're like, I need you to be on a regular cadence. Now, one of the best situations I ever saw was a guy, founder. He must have had something on his desk, like he would keep little notes or something, because at the end of every month, he would send an email to the investors, friends of the company, whatever. This wasn't like a confidential email, but it was like, hey, here's what happened. Here's like how many customers we got. Here's what happened with the company. Here's like what we did, what we didn't do. Here's where I'm struggling. Here's where I could use help. He sent this email every single month. And I will tell you what, people had confidence in him at a level that they didn't have confidence in anybody else. And you know what? He was being honest. He was like, this is good. This is the good thing that happened. This is the bad thing that happened. Right. I absolutely loved him as an entrepreneur.
So tell me about when founders are, when they're pitching their idea, what are they too focused on during their pitch, in your opinion, often, and what are they not focused on enough in general?
Yeah, like I said, I think they just get too focused on the tech part of it, like whatever the technology is. It could be healthcare, it could be an actual technology, but they get so wrapped up in their solution. Yeah. And they also think that their solution is just head and shoulders and completely different than anything out there. But they do have competition. Like if anybody ever says to me, hey,
Right.
you know, we're
the first to do this.
No,
Yeah.
we're really the first to do this. There's no other competition. Okay. There might be something exactly like what you're doing, but whatever the problem is, so about going back to the problem, like whatever the problem is that you're solving, then that problem is being solved by something.
Right.
Right.
Sure.
It might
Sure.
not look exactly like you, but is being solved somehow. So you have to think about all of the solutions.
Totally.
And then go from there.
So this is one thing about pitching in general that like, this is just a self-serving question. I just truly don't know this, but people always have questions that other people have. So I'm going to ask it. Like the idea of market research, because you started touching on that, and the idea of putting numbers to your solution, putting numbers to the opportunity that, you know, they're inviting you to step into and partner in. That to me feels like such a, like, I'm just going to take this number out of the air and just like put it on the thing. And we're all just going to just sit here like an open secret and think that I have some kind of 3-year forecast on what those numbers are going to be. Like, what is that, that back and forth, that play, that kind of game that feels like it's played of like, listen, we all know this is, especially in a newer area, newer solution, one giant guess, but there has to be numbers on the paper. Like how should founders navigate that?
So, you know, as angels or as investors, we usually do all of our diligence in a group because one person isn't really going to be able to do all the diligence. And then we actually try to get multiple groups sometimes to do it because the more eyeballs, the better, right? The more you can start to have conversations like, do these financials make sense?
Right.
Like, would this actually like, so there's kind of this saying that, and it probably needs to be even more so, but that you would look at the financials and as an investor, you cut the whatever they think they're going to like have in revenue, you know, by year 5 or whatever it is, you cut it in half. And then you also say, well, it's not going to be year 5, it's going to be year 10. You double it. Right?
Okay.
So that's kind of like a saying, but it's probably like, you probably have to look at the number and cut it like down to a third.
Yeah.
And then you probably have to like triple the amount of, you know, time it's going to take. So a lot of it is, you know, what I hate to see is you'll see a company that's been in business for, let's say, 2 years, and they have had, you know, very little revenue in the first year, which is to be expected. And then they really don't have that much of an increase in the second year. But they're going to tell you that in the third, fourth, and fifth year, it's just going to go up like crazy. And you're like, really? Like that is so not reality. And then by the third year, you're like, so you said you were going to hit, you know, this number and what's going on there? And they're like, no, that didn't happen.
Yeah.
So I think sometimes that's where, you know, back to your earlier question about like, how do you really get to know people? What do you, how do you get that like intangible? Then sometimes when you're having those conversations, if the CEO especially, or the founders in general, cannot explain how they came up with those numbers, that's bad. Because what I'll find is you can get them to like basically bring in some kind of fractional CFO or some kind of fractional finance person who will make all those numbers up for them. And then they're like, okay, that looks great. But they have absolutely no idea how any of those numbers came to be, and they will never, ever be able to get there. So if they don't really understand all the assumptions behind the numbers and how that's all going to play out, not going to happen.
So what I'm hearing you say is like, yes, there is of course this sense of like, it's an assumption. It's maybe like a guess, even less than that. Like it's, but we want to know that those are informed guesses, that those are things that like that there's reasons behind those numbers, even if you're off on that, but like that you thought it through, that there's some evidence, some chain of evidence of like, oh, okay, yeah, maybe even I disagree with you on the ultimate number, but I see your thought process and that's thoughtful rather than just like, yeah. And then like, oh, definitely 3 times, 10 times, 20 times. Yeah.
Totally.
Yeah, that makes sense. You touched earlier on milestones, on this idea of, and revenue is certainly one of them, these milestones that you guys will have expectations as investors for founders to be hitting, whether those are expectations they're setting for themselves or you're setting for them. What are some of those that you're looking for that a founder should be prepared to speak to and prepare when they're pitching?
Well, in a lot of cases, the product or whatever it is isn't fully built out yet. So sometimes it has to be like, okay, do you have...
I guess as angels, you're saying you're coming in so early. That is the case a lot of the time.
Right. Or they have a beta product and you're just trying to see like what's going to happen once we get it in the customer's hands. And so, that can be one way. But then, just seeing how the company is developing, and if they're saying, well, one of the milestones we're going to hit is that we're going to have, let's say, 3,000, I'm just making up numbers here, but like 3,000 customers that are using the product. And then we're going to have like 300 that are paying. And then we're going to have like 1,000 that are on the premium plan or whatever it is, however their modeling goes, whatever their pricing structure is going to be. So those are the types of things, like that would be like a concrete kind of milestone where you're like, okay, by this date, you're expecting that you're going to have this many customers, blah, blah, blah. Because I've talked to way too many companies that I'm going to be, and I'll actually ask them, so how exactly are you making money?
This all sounds good, but like, how are you making money?
How are you going to make money? Because like, they'll be like, well, we're going to have all these customers. I'm like, how about paying customers, right?
Mm-hmm.
How about like, how are you actually going to get this product that people will want to pay for and they will want to continue to pay for, right? Then they're not just going to buy it for, a month or two and then be over it.
Yeah, no, that makes sense. And, related to milestones, you mentioned earlier something about, you cut the revenue in half, you multiply the timeline by 2 to really understand what might be a more accurate guess. And you mentioned something like 10 years. What timeline are you thinking of as an investor? Because I've heard from VC firms and stuff, everybody's so different. But I hear often that like it's a very aggressive, it's very short, right? Like they're wanting an exit very quickly. Like if we can't see our money back in 3 to 5 years. And is that different for angels? How are you guys thinking about timeline for investing?
Well, 3 to 5 years we would love. If we get in to some of the deals at a later stage, we could maybe think that that's true. But I think to be realistic, if you're coming in, really early, you have to be prepared for that, 7 to 10 year time horizon. And this is why you don't want to use money that you need, anytime soon. Don't use your vacation money. Don't use your kids' college fund when they're 16 or anything like that. Have it be something that you can afford to lose, but yet you really care about what the company's doing. You want to see this, come to fruition. But then we haven't really talked that much about diversification. And if you don't diversify your portfolio, that's when the risk really does come into play. So I did write a book called Do Good While Doing Well to try to demystify all of this. And in there, I talk about 2 people who ended up making 3 investments early as angels, 3 different companies for each person. And the one person had I think 2 of the 3 companies exit in 3 years. It was amazing. And this person thought, and they got a ton of money back. So they thought angel investing was absolutely the greatest thing that ever happened to them. And then the other guy, he said, you know what, all my companies went out of business in the first year. So I think angel investing is the worst thing that in the world. Nobody should do it, right? So those are 2 kind of extremes of neither of them are really reality. You don't really see somebody only investing in 3 companies and having 2 out of the 3 just hit it out of the park. And you also, you could have 3 companies just totally go out of business, but only investing in 3 companies is not a smart strategy. Yeah. And so I know that was something that I kind of messed up on at the beginning is I didn't really understand funds, diversification. There really wasn't that much to invest in back then. So nowadays there's all kinds of things you can invest in for much lower dollar amounts, but sometimes with venture capital firms, you have to have $250,000, even $1 million to invest. Now you can invest in angel funds for as little as $5,000 or $10,000. So it's much more approachable to somebody who's an accredited investor. But, this is something that I always caution people, make sure that you have enough money set aside that you can get a diversified portfolio. And when we say that, it just means you want to invest in at least 10, if not 20 companies. And sometimes that could be through a fund. You could write 1 check and you could get immediate diversification into even 15 companies just from one investment. So that's why if people ask me how many companies am I actually invested in, I don't know that I could really give you an answer because I really like funds. And some of the funds have, many, 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 many companies in it, even though I didn't write a very big check. Do you know what I mean? So you can kind of you can spread out your risk at the same time getting exposure to a lot more companies. Yeah,
that's a really cool way to do it. I know specifically I graduated from Baylor and they have a pretty active angel network. And I'm assuming that's a pretty good avenue for some people to look at your school.
Yeah, there are lots and lots of alumni angel groups out there.
Cool. So you started touching on it. This is a great segue. Let's go straight into, companies that you are passionate about. That's kind of, I think, probably how you started, of like you looked at these companies, even if it was just a few and that wasn't as advised at the beginning, but to look and say, oh, I believe in this. Like I believe in this vision, believe in what this founder's doing. This should exist in the world and somebody's got to build it. They're building it. So like I want to help support that. Talk to me about, and I know you're specifically have a lot of passion around women-led and minority-led startups. Talk to me a little bit about that.
Yeah. So, like I've been talking about, it is a risky asset class. So you have to think about it in a different way. If I'm thinking about it like, hey, all I care about is I just want to invest money in, I want to see, if I could, find the next Google or something like that, which is out there, it's possible.
Yeah.
But that isn't really a good reason to be like, hey, I'm going to invest in angel stuff. But these companies, and there's a lot of them out there who are working on incredible things, treatments for diseases, cures, how to save the planet, how to, change our climate, all these things. So if those are things that you care about, aligning your money with your values in a way that can really help bring some of these things to life can be, really rewarding to be able to think to myself, hey, I actually got to help a company that's working on an Alzheimer's drug, and which is one of my investments. And I thought, this is really pretty wild. Like I could be a part of that. And maybe the company doesn't ever go anywhere. They are still in existence, which is great. But they, even if they didn't, when I first invested, I thought to myself, well, this really matters to me. So if I could at least move the needle forward a little bit and be a part of that, that would really, make me feel good.
You say something, I know that it's like if you want to see change in the world, you have to be it, invest in it, or create it. What is it?
That's right. Yes.
Yeah. And I think that's really neat. And it's a really cool thing to think that as someone who just might have some money to be able to support a founder, that could be your role. Like you don't have to go out and quit your job or do something totally different, make some radical move to start this yourself and build this yourself, especially if that's not your gifting. But you can support and create change in the world in other ways. I love that perspective. Let's shift a little bit to, I know that you, and I don't even know if I'm saying this right, so correct me if not, but that you are an advisor to the SEC. I think that's the way you say it, but talk to me about that experience. Like, what are you doing with them? How are you helping influence legislation, what they're putting in place to support entrepreneurs? What does that look like, and what have you learned? That's a pretty cool experience.
Yeah, that's a cool experience. Yeah, so the committee is called the Small Business Capital Formation Advisory Committee, which is a big mouthful. But what we're trying to
acronym?
do... Yeah. Yeah, but you can't really pronounce it.
I guess not.
There's too many letters and consonants in there. Anyway, but it's really interesting because the committee is made up of about 20 people, and it's extremely diverse, which I love. And when I say diverse,
Cool.
I just don't mean racial or gender-wise, although it is. But it's diversity of thought and the type of background that we all have. So we all have our own little kind of niche into how capital gets formed or how capital even gets deployed into our economy. And for example, I'm one of the main people who represents the angel groups. And then there's somebody else who has a lot of experience with the disabled community. So there's so much variety, and it leads to some incredible conversations about how can we actually get more capital flowing to small businesses. And because small businesses are the heart of America, really. So how do we do that? And it doesn't always mean startup. So yes, we've been talking most of this time about startups, but small businesses are everywhere.
Yeah.
And, how can we get more capital to them? How do we help them, survive during turbulent times? So what we do is we talk about a lot of the things that are in the SEC's control. So, which does get a little gray as far as what is it that Congress controls versus what is it that the SEC controls. But so for example, one thing we've talked at length about is the accredited investor definition. And while I've been on the committee, we actually made a recommendation to the commissioners that we wanted to expand the definition to include education, which I personally feel very strongly about because just because you have a lot of money doesn't mean you're a very good investor, right? So I always like to incorporate way more education into it so that people feel comfortable, and then they'll make better decisions, and then they'll actually will be more change in the world.
And as you said that, that's really cool. That's such a neat experience and really cool service that you're providing to, the country. It might not feel like that, but it is. That is a neat piece that you say about education. When you said that, I thought that's both ways, right? You think, oh, we want to protect the investors, which is absolutely true. Make sure that people have the knowledge they need to invest wisely. But also protect founders who might get cash that they're not ready for, might get cash that like their business shouldn't have at that time. If investors are unwisely putting money in places they shouldn't be, businesses can get cash that, aren't ready for it or shouldn't be funded at that time with that team or that idea. And you see startups fail, I'm sure, at a much higher rate if people are giving money in an uninformed, uneducated way. Let's talk a little bit about, from your experience of what you've seen, we kind of are bouncing back and forth from your experience and other things to also actually like being pitched to founders asking, for you to invest. And when you do that, when you are investing in companies and you're seeing these companies go forward, hopefully you're getting updates more than once a year on like what these companies are doing. What word of as founders get some money from you, from others, they're raising capital, they start growing. That is just such a tenuous part of the business, right? Is like, okay, here we go. And like you start scaling. What is a word of caution you can offer to founders who start that process? Something that you've maybe seen other founders learn the hard way, that once you start scaling, like what can be done right, what can be done wrong, what's some words of wisdom in that moment of like, we're going to start building and scaling from here?
Well, there's one company in particular, I won't name them, that I can think of where a specific example where they did start to grow and scale quite a bit, but they weren't taking into consideration their supply chain. And, really, when I say supply chain, like basically, how are they getting, it was something that got shipped to a customer. And so there was a lot of logistics that went into that. They had to get everything, build everything themselves, and then they would ship it out. So there were a lot of things that were to be taken into consideration in order for the company to do well. But the product was something that people really liked and they wanted more of it. And so as they started to grow, they weren't taking that into consideration. They weren't pricing their pieces right. They really weren't even sourcing all of their materials from the right places. And so then the cost of their materials started to go up. They weren't charging the right prices to the customer. So then they start to raise the prices on the customer. Customer doesn't like it. And then all of a sudden everything kind of just goes down a ball of flames. So, that's a good example of like, as they start to grow and scale, that doesn't necessarily mean like, hey, this is all going to be, bed of roses now. With growth comes growing pains, and, just being on top of all that is important, which is why you need an ops person.
Yeah. Back to that. That's so true. And making sure things are set up the right way to begin with, because something unhealthy that grows won't magically become healthy. It will grow more unhealthy, like a bigger, nastier ball of unhealthy. But if things are in the right place, foundational things like, pricing, making sure you're priced correctly right away. That's great advice. If there's anything you can speak to here, I think it'd be really helpful to talk about hiring as well, because that's just also, as I talk with other founders, it's just such a, so many of them start on their own or with them and one other person or them or two other people. And they think, okay, like we have some capital here. We actually have some momentum. Let's bring the right people in to begin this process. What are some pitfalls you see there? Founders making incorrect decisions, founding teams making incorrect decisions in that moment. What words of advice do you have for when it's time to bring people into your vision and start going?
So first of all, let's say you have 2 or even 3 founders, co-founders, and they haven't worked out who's doing what for what equity. That can get very dicey. So you need to have those really hard conversations of, I'm going to do this, you're going to do that, you're going to do that. And by the way, that doesn't mean like a third as far as equity. That's like the worst thing that you could do.
Yeah.
You really need to figure out who is going to be the main person, who has the majority ownership stake, and then, make sure that all those conversations have been had. Then when you start to bring in new people, they aren't going to wonder, wait a minute, how come one guy or one person and this, then there's a lot of like the new people will then wonder if that hasn't been buttoned up to begin with. So that needs to happen. And then there's always that saying, you want to hire slow and fire fast. And in startup land, it is so challenging. You make one wrong hire and it really can tank your whole business. So I always tell entrepreneurs, you want to be talking to people way before you need to hire them. Get them involved in what you're doing. Not that they're going to work for you or anything, but just let them know what it is, see if they're interested in it. I mean, it is a labor of love to be part of a startup because it is not a 9-to-5 job.
Right.
Whether you're a founder or you're just an early employee, you're doing a lot of work and you're doing it for a long time. So you want to make sure that there's alignment there.
I hate to ask this, but I think it will be really insightful. What is a failed investment that you made that maybe still stings? What did you learn from that?
Oh, yeah. Oh, that's not a bad question. Okay, that's how you learn, right? You learn from the mistakes. Even as investors, we learn from the mistakes. So I think at one point I did say that you have to be kind of cautious about the people who are really great salespeople. So one of the first investments that I ever made, the founder was really, really good at pitching. Won all kinds of awards, all kinds of pitch competitions. They won money, contests, was really, really good at that. So then that led people to have more confidence in the CEO because he was just so good at talking about it. Until one day he decided that he just didn't really like doing it anymore and he went and got another job.
Whoa.
And that's the only time I've really ever seen that because most of the time you'll see the founder go down with the ship,
Yeah, totally.
just to completely walk away and be like, yeah, I'm not really into this anymore.
Wow.
Was very surprising. Yeah.
Yeah, I bet. And so I bet that really kind of gets you keenly aware of that in the future of hey, are they really good at pitching because they are very passionate about this product and they live and breathe it? Or are they really good at pitching because they're good salesmen and good saleswomen? Right. That's a good point.
That's basically what happened here.
So let's move into some closing questions here. When you speak to other entrepreneurs, that doesn't even just have to be when they're pitching to you, just when you're talking with other entrepreneurs in this space, in the startup and entrepreneurship world, what's a question that you get asked most of the time? And then what's a question is equally as important that they're not asking, but they should be asking?
Well, so in a lot of cases, and I get this even on LinkedIn, which is kind of crazy, that people will be like, hey, can I talk to you about, blah, 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 or can I pick your brain about this? And what kind of drives me a little bit crazy about that is that, yes, as investors, we're looking to talk to companies and deal flow and all that. But if I don't know you, if I haven't had any kind of a relationship with you before, and now all of a sudden you're asking me for money, that isn't a good place to start. So crazy. I always tell people, entrepreneurs, they really need to be thinking about the type of money that they want to raise, how much, from who, way before they need it. And they need to start building those relationships because those are the only people that I've really ever invested in. I have never invested in somebody who just sends me some kind of a blind email on LinkedIn or,
It makes you think media. Who is? It's just bizarre. When you get stuff like that, it's just bizarre. It's if you're starting off on that foot, who have you been successful? Has someone reached back out and yes, let me hear more. I would love to invest in you. I don't know. But I actually do think what I do encourage entrepreneurs, and this is the part that I don't think they ask, is that if they have something that they're very passionate about, and let's say it's a specific niche, I was talking earlier about curing Alzheimer's disease. So find the people that also really care about that. And don't approach them about being an investor, but find out who those people are and start your network that way. Yeah.
So it's not you have to go out and be I need to find investors.
Right.
You need to go out and find the people who care just as much as you do about whatever it is that you're doing.
I really like that. Yeah. Start with the problem. Start with focusing on the problem from both sides, from investor and founder standpoint. Right. Focus on the problem. Who else is passionate about it? So imagine, Marcia, you woke up at the start of your career. You somehow retain all the knowledge and experience that you have now, but you're back at the start. How would you kind of spend that first week of your fresh start?
Yeah, well, that's really why I started my podcast, The Angel Next Door, why I wrote the book, because I was if I could go back and tell myself back in 2012 all that I know now, what would I do differently? And I would have a more solid plan about what I was going to invest in, why I was going to invest in it, and how much money I was going to set aside at that particular time in order to do that, so that I was very, very clear on what it is that I cared about and how I wanted to align my money with my values.
And then lastly, and I want to talk specific, I want to pull back out, you've mentioned your podcast and your book, and we'll talk more in depth about that a little bit here at the end. But other than those, what's one tool, quote, or book that you found indispensable to your professional or personal progress?
So this isn't really a book that you would sit and read and it's a page turner. Okay. However, there is somebody in our industry who's very well known, really amazing person, Brad Feld, who wrote a book called Venture Deals. And I think I have a copy of it on in almost every room of my house. And I have it on my, Kindle and everything, because it is an incredible resource as far as if you're already an angel investor. This isn't going to teach you necessarily how to be an angel investor, but if you already are and you aren't sure about terms in a term sheet, you don't really understand what they mean by participating preferred stock and all these crazy terms that gets thrown around. This book is absolutely incredible for that.
Nice. Awesome. Sounds kind of almost like a field guide, like a user manual for how to do it. That's neat.
Totally.
And so, yes, but you have a podcast and you have a book, and you mentioned the names of both, but let's circle back to both of those. What are both of those and how can people find them?
Yeah. So in 2021, I started the Angel Next Door podcast, basically because, again, I was like, how come more people don't really know about this? Like, why? I would talk to people and be like, hey, this is what I do. And they're like, really? Yeah, right. You do that? And
do you have $1 billion?
Yeah, exactly. And I'd be like, no, it's not really like that anymore. And they'd be like, oh, I thought it had to be rich. I did that. So I'm trying to demystify a little bit. Like the name of the podcast is a little bit of a play on the book, The Millionaire Next Door. And, that basically can be anybody. So I highlight people who are angel investors. How did they become angel investors? What money do they use? All that kind of stuff. And then it's kind of morphed into that because now that I'm on this SEC committee, I've had a couple commissioners come on, a couple U.S. Congress people telling us about, why they care about entrepreneurship in our country and things like that. And then also I've had, I mentioned the 3 equity crowdfunding sites. I've had all 3 of their CEOs on.
Oh, cool.
So, just all about demystifying. It's just a big demystifying thing. And then I spoke at TEDx Charlotte in 2022. And from there, people were like, okay, that was 11 minutes. Can you explain a little bit more? Right. And then hence the book.
Okay, awesome. And people can find that on Amazon or anywhere. Okay, awesome.
Do good while doing well.
Awesome. Great. Well, Marcia, I really appreciate this. This was packed full. Lots of really insightful things. You have a breadth of experience and just really, really valuable. And I appreciate you offering that to us today. Thank you.
Well, thanks for having me.
If you guys enjoyed the show, leaving a review is the best way to help others find it. Second only to sharing it directly with your friends and family. Thanks so much for helping get the word out. Hit me up at brandon@readysetstartuppod.com if you have additional questions about a topic I covered, have suggestions about another area you'd like to see me dig into, or just want to say hi. Please reach out. I'd love to get in touch. Keep imagining, keep creating, keep inspiring your spheres of influence with what you're passionate about. The world may just need that dream that's in your head. See you next time.